Now we discuss the other capital budgeting techniques. One of these techniques used by managers to evaluate projects is the payback period. This approach tells us the number of years required to recover our initial cash investment based upon the expected future cash flows from the project. First, management determines a cut-off period for the project. Then the number of years required to recover the project cost is compared with this cut-off period. The decision rule is to accept the project if the payback period is less than the cut-off. If the number of years exceeds this benchmark, the project is rejected. Applying the payback rule to our example, we assume that management has set a benchmark period of 2.75 years. Thus, only projects that pay back within this period will be accepted. We perform the calculation and we see that the European project is rejected as it doesn't pay back within 2.75 years. That project will pay back at the beginning of year 4, because that is where the cash will be fully recovered. The Australian project will pay back within the specified period, as over the first 2 years we recover 40 million combined, and then in the third year we recover the rest of 10 million in the first half of the year. Thus, based on the payback, the firm should accept only the Australian project. The payback has a few advantages, being that it is easy to understand. It takes in consideration the fact that later cash flows are more uncertain and is biased towards liquidity. The quicker the money is recovered, the more chance we have to use our money in other projects. The disadvantage of this method is that it ignores the cash flows at a later period, and then there is no discounting involved, thus does not account for the time value of money and risk. The biggest problem, though, is coming up with the right cut-off period. What is the rationale behind cut-off being 2.75 years? Why not 3? Also, the payback does not tell us if the project adds value to the shareholders. Who cares that the costs are recovered in 2.75 years? What shareholders want to know is, does it add value to the firm? Another issue to add is that payback is biased against long-term projects, such research and development, where there is a huge initial outlay and a long time for the project to start paying some rewards. Therefore, if you have a short cut-off period, you would never take an R&D project based on the payback rule, because it will never pay back in such a short time. A variation of the payback method is the discounted payback. The difference is that we calculate the length of time required for an investment's discounted cash flows to break even. So first we calculate the present value of cash flows, then we accumulate them to calculate the time required to pay back. And then we compare this with a cut-off time established by the management before. Applying the discounted payback to our example, we see that neither of the projects should be accepted, as they don't pay back on a discounted basis based on the management cutoff of, again, 2.75 years. Although it accounts for the time value of money by discounting the cash flows, the discounted payback still ignores cash flows beyond the cutoff point, which we said is arbitrarily set. Also, using this technique, we take the chance of rejecting positive NPV investments, and it is biased against long-term projects such as R&D and new products. Another way to decide whether to take on an investment or not is to use the accounting rate of return rule. How do we apply this rule? First, we calculate an accounting rate of return which is just a ratio between the average net income and the average book value of the firm, and compare it with again a target rate set by the company. The decision rule is to accept if the ARR is greater than the benchmark, otherwise we reject. Although it's easy to calculate, the accounting rate of return is even worse than the payback rule in that it doesn't even use cash flows in the analysis. It uses net income and book value. Thus, it ignores all those important features like time value of money, risk, and value added. Furthermore, ARR is sensitive to the change in the depreciation method applied to the project and the rate of the depreciation used and the valuation of inventories, for example. These will affect both the net income and the book value of the investment. Thus, the decision to accept or reject a project can change dramatically as we change these variables. Applying ARR to our example, we assume the firm has set a target rate of 25%, meaning that projects will be accepted only if their accounting rate of return is above 25%. In the table, we are given the income expected from these projects and for which we take the average. Also, we are told the depreciation details, straight line to zero, meaning equal value of depreciation per year with zero book value at the end. From this, we take an average, the book value for each, and then we calculate the accounting rate of return. We see that both projects are accepted based on this technique and both have a greater accounting rate of return than 25%. The last technique used by managers to evaluate projects is the Profitability Index. It measures the benefit per unit of cost based on the time value of money or the value created per dollar invested. Profitability Index is calculated as the present value of cash flows divided by the cost of the project. And the decision rule is we accept if the project's profitability index is greater than 1 and reject otherwise. Note that the present value index would be greater than 1 for projects with positive NPV and would be less than 1 for projects with negative NPV. Applying this rule to our example, we see that both projects have a profitability index of greater than 1, so we can accept them both. We can say that for every dollar invested, we get back $1.30 from the European project, out of which 30 cents is the value created. Similar with the Australian project. For every dollar invested, we get back $1.50, out of each 50 cents is the value created. If we have many projects to choose from and limited capital, and all projects have positive NPVs, the PI tells us which one creates more value. Therefore, we will allocate funds to those projects that have the highest PI. In that case, we would select the Australian project. The PI has the same disadvantage as internal rate of return when they are mutually exclusive projects. The PI is size biased. We can accept a project with a higher PI, however, they might not have the greatest NPV. If, for example, our projects would be mutually exclusive, based on the profitability index, we would select Australian project and it has the higher PI. However, this project does not offer the greatest value. Thus, when we have mutually exclusive projects, always use the NPV to base your decision on which project to accept. Disregard profitability index, disregard the IRR when we have mutually exclusive projects. In practice, nowadays managers use NPV and IRR the most in Australia, compared with the 1950s when only 9% of managers used the discounted cash flow methods. Throughout the years, the popularity of methods have varied, also depending on the industry and the type of the project assessed. Remember that NPV, IRR, and PI always agree on the decision if project is independent and has conventional cash flows. When deciding between mutually exclusive projects, IRR and PI ignores the size of the project and should not be used. Ultimately, when in doubt, use the NPV. When comparing Australia with Brazil, France, Germany, UK, and USA, we observe that NPV ranks first, followed by the IRR and the payback. Similarly, in the US and Brazil, NPV and IRR comes first, followed by the payback. Note the difference in the UK. Here the payback ranks first, followed by the IRR and NPV. While in France, the use of real option is the preferred method of capital budgeting assessment, followed by the payback and the NPV. This concludes this module.